Welcome back live here to Future Proof in Huntington Beach, California. Our next guest recently called the current investing environment one of the best he's ever seen. Rick Rieder is BlackRock's CIO of Global Fixed Income, also its head of its global allocation team. He joins us now. It's good to see you out here by the beach.
Wow, pretty nice.
So you made that statement with me on Closing Bell, and since then the market continues to go up.
Yeah.
We got a bad jobs report, and this feels like it is very much a rate cut rally. Don't fight the Fed. Is that what it is?
So, by the way, I think that quote went crazy in terms of people repeating it. It's taken a little bit out of context. Do I think the equity market's going to go up? Yes, I think it's still going to go up. I think the technicals are extraordinary. Why I think it's the best investment environment, you have a couple of things taking place all at once. Technology's changing. We've got incredible earnings growth at a number of tech companies. That's exciting. You've got bifurcation across different companies. In the fixed income market, you've got income everywhere. You can still create 6% income until the Fed cuts rates. That's super exciting in different areas. You've got publics, you've got privates, you've got gold, you've got Bitcoin. There's so much to do that it's the best I've ever seen in terms of figuring out where it is. And to be an investor is as exciting as I've ever seen.
Did you just say that those opportunities exist in fixed income until the Fed cuts rates? Because that's going to happen next week, isn't it?
Yeah, so...
By the way, they're going to cut next week?
Yeah, they're going to cut. I think they should cut 50. They're going to cut 25, probably. It will depend. The CPI report that's out tomorrow will be or Thursday will be interesting. Listen, I think they should go 50, but I think they're going to go 25, and then we're going to start moving rate down. That being said, you can still build a portfolio to get this sort of yield. And by the way, you can still stay in the front to the belly of the yield curve, get that yield. We've been extending a little bit out because now your real rates are pretty exciting. Get the things that are interesting. Real rates now, if inflation's running 3-ish, these real rates are actually okay, out the curve now.
Okay, so this is the best opportunity before they cut rates to take advantage of a trade that will still work after they make that move, but you're not going to get as good of a value on it as you will literally like now.
Yeah, ironically, people are cynical, say, I want rates to come down because it's good for it. Actually, for an investor, by the way, if you're in this country and you're a wealthy saver, these interest rates are phenomenal because you can just keep clipping income. Like, I would rather rates stay, from a commercial point of view, I'd rather rates stay here. From what I think is best for the economy, and particularly lower income in this country, I think we got to get that rate down.
Are you worried at all about stagflation? And if so, where on the concern meter does it fall for you?
I don't know what the extreme low end of the meter would be characterized at, but I think, so we're going to run, by the way, our projections this year, we're going to run 4.6% nominal GDP. We've run almost 5% or 5% plus nominal GDP the last couple of years. It seems like every time, particularly the first quarter, second quarter of this year, people say, oh, God, the recession is coming. And then at the end of the day, the numbers come out. So, no, I think growth. I think we can get real GDP of about 2%, maybe just under 2. You put some inflation on it, you get nominal GDP which is close to 5, which, by the way, with the debt burden we've got in this country, having a 5 nominal GDP is pretty good. Okay,
so we mentioned the call you made with me on Closing Bell, and when you said it, I quite literally said to you in that moment, wow, if they're watching at the White House, they're probably standing up and saying, yes, that's what we're talking about. The Fed needs to cut, and this is a great environment to be an investor. And lo and behold, less than 24 hours later, your name appears on the short list to be the potential next Fed chair. What do you want to say about that?
So I don't want to say anything about that, but all I want to say, by the way, when I heard that, listen, I've had a long career. It's an unbelievable honor to be even mentioned in that list. It's a great group of people. To even be up there is a pretty neat thing for me. What do I think about it? Listen, there are a couple of things that run through your head. We are now talking about a Fed that can move 25 basis points, and maybe they do it 3 times till the end of the year. Moving 25 basis points of the overnight funding rate is not that exciting. There are so many innovative things. When we finance resi, commercial real estate, asset backs, you think about cap stack, you think about what a Fed could do. So whoever ends up being the Fed chair, there's so many innovative things. How do you use the balance sheet? How do you use liquidity? Where on the yield curve is it? By the way, the Fed's reducing mortgages at the same time we have mortgage rates too high. That's hurting a huge number of people in the country. We are seeing something in the country today that we haven't seen with this intensity in an extended period of time. Low income's having a really hard time. And, I don't agree with the thesis that, well, tariffs are inflationary, we've got to fight in tariffs. You think about, and by the way, it's half the country that's having a hard time. If you think about today, if you're being burdened by tariffs, and largely it's goods, so the goods are where lower income, middle income suffer from when you have goods inflation, to say, gosh, we're going to charge you a higher rate to borrow too, it doesn't feel like that is equilibrium. I think we can get that rate down.
Have you had your interview yet?
I cannot. I can't talk about that. I'm enjoying what I do. I'm enjoying being here with you. I'm enjoying investing. That's
okay. Fair enough. We obviously are having a pretty deep conversation these days about Fed independence and what the future of that holds. Ken Griffin wrote in the Wall Street Journal just a couple of days ago, quote, pressuring the central bank to adopt a more permissive stance towards inflation carries steep costs. These actions raise inflation expectations, increase market risk premiums, and weaken investor confidence in U.S. institutions. How do you feel about the issue of Fed independence, and what do you make of what Mr. Griffin had to say about it?
So a couple of things. So for the smart guy, I would say, listen, I think Fed independence is critical. If you think about how today, one of the big critical items for this country is we got to fund debt globally. People have to have confidence in we're managing the currency, we're managing our debt stack effectively. So I think Fed independence and our debt costs effectively. I think Fed independence is superior in terms of importance. That being said, I still think there are creative things that you can do. And if you said to me today, inflation is running a little bit hotter, we've got some tariff transmission. I think if you go back 2 decades prior to COVID, we couldn't get inflation to 2. We couldn't get it to 2 on the high side. If you think about where the next 5 to 10 years are going to be, we are going down what I think is the most extraordinary period of technology, productivity, and quite frankly, after you get the fiscal tailwind next year, I actually think the bigger issue is going to be putting enough people to work. You're seeing it today, and you saw the revision in payroll today. You're seeing weak labor. If you strip healthcare out, you have negative job growth. I think people underestimate we're going to displace a lot of people from jobs. To me, for the next 5 to 10 years, yes, you've always got to manage inflation. You always got to be thoughtful about it. By the way, 5-year inflation break-evens today are 2.5%. If you got the funds rate to 3.25%, you're still above the rate of inflation. Today, if you ask young people about getting a job, if you ask people in urban settings about getting a job, it's really hard. That, to me, is going to be the secular discussion over the next few years.
Speaking of the discussion, I mean, what do you make of the way that both the bond market and the stock market are telling sort of different narratives about what the current environment really looks like? Tony Pasquarello at Goldman Sachs, I think somebody you know quite well, as do I, and I know he has great respect for your views on the market, and I think it's vice versa. He says bonds are principally focused on the current slowdown in the labor market, while stocks are looking forward to a cyclical acceleration. If equities were to get genuinely concerned about the growth outlook, the downside tail could really open up, given the interest rate strip has already pricing in a lot of easing. Is that fair? Do you agree with that?
He's very good. I would say a couple of things. One, I always find it hard interpolating what the market is telling you. Oftentimes the market tells you what the technical condition is. So think about the equity market. Earnings growth's pretty darn good. Like when you wrap up second quarter earnings, it's pretty impressive what we're still able, by the way, a lot of it through cost cutting. You didn't see a tremendous amount of revenue growth. Market is telling you earnings growth is pretty good and anticipated to continue to be pretty good. And we talk about it all the time, there's a massive amount of cash. The buybacks relative to the IPO calendar dwarf it. It's what, $1.3 trillion versus 50, 60 billion we'll get this year. Technicals and equities are amazing. What the bond market is telling you is the funds rate is too high. We got to get that funds rate. What is neutral? I would argue, is it 3? I actually personally, given what we talked about around technology and productivity, I think it's a little lower than that. But the bond market's telling you we got to get to at least neutral, and it's going to happen. And I think it should happen faster, but it'll happen over the next year and a half or so.
What do you think the ideal portfolio is supposed to look like today? We're surrounded by investors. We're surrounded quite literally by financial advisors who are thinking about that. Retail investors who are watching. I mean, what does it look like today?
Very different than the past. So maybe I'll start with the equity market. I mean, the first thing I would say, we're going through the most extraordinary technology dynamic I've ever seen before. I would stay long equities. By the way, you can buy volatility very cheaply to manage your exposure. I'd stay long equities oriented to where growth in technology is. In fixed income, income is amazing. you're still clipping 6%. Would I stay 5 years in on the curve? I'd still clip that coupon. We're extending a little bit out. And then, quite frankly, I mean, there's some interesting things to do in privates, bespoke markets. And I think hard assets have to enter the equation today. Gold, Bitcoin, things that give you a little bit of ballast in the portfolio against potential for currency depreciation.
When you talk about Bitcoin should be part of the portfolio, what kind of percentage are you thinking about? Is it a 5%, which generally seems to be what people are talking about, more or less? It
seems high to me. So I run our global allocation fund. You know, we're running long equities. You know, we're heavy income. You know, we're running, you know, in the 3 to 5% region on gold. Gold strikes me today as a better currency hedge. Bitcoin tends to trade with vol, tends to trade with the NASDAQ. So we're running considerably lower than that in crypto. I just think it's going to go up, and I think it's a good expression. But 5 seems high to me, but it depends where you are in your life and how much risk you want to take.
Well, we'll see you on the stage, the big stage, I said, as the headline speaker, the keynote today. Rick Rieder, thank you.
Thanks for having me, Scott.
All right, joining us here at Future Proof.